Foundations of finance. Here are some basic concepts you should know about finance. First one, that is income. Income refers to the money that a person or entity receives in exchange for their labor or products. That is, whenever you deliver goods or services, in exchange of that some sum you receive, which is also known as income. So it's a activity to you. List out different sources of income. There are majorly three sources of income: business income, personal income, and income from investment. List it down. Business income. It's a revenue that a business earns by selling its goods and services. Whereas for individuals, it may be the income or compensation received for labor, services, and investment. For example, wages, salaries, commission, revenue, pensions, interest. Whenever you work in a company or a firm, you receive these benefits. Gratuity. Gratuity is a benefit that is payable under the Payment of Gratuity Act 1972. This is an important concept that you should know. Gratuity is a sum of money paid by an employer to an employee. Your employer pays a sum of money to employee for the services rendered by him. Gratuity is only paid, please note this, when employees complete 5 or more than that in a company. Please note, gratuity is paid only to employees who complete 5 or more years in a company. Revenue. Revenue portrays a aggregate sum of money procured by association by offering its services and products. It's a total amount, revenue. While income is obtained by deducting all the expenses. Whenever you deduct your expenditure from the revenue, it gives you income. So revenue is the total amount that you generate by delivering your goods and services. When you deduct expenditure, that is expenses which may be direct or indirect, you generate income. Now, what is expenditure? Expenditure is referred to as act of spending time, energy, money on something. It's basically what you spend. It means money spent on purchasing goods or services in economics. Examples of business expenses: payment of wages, salary, factory, office lease, rental payment, payment made to vendors, raw material expenses, advertising agent, website maintenance. You have an activity to list the income and expenditures that are part of your family. List it down as much as incomes and expenses if possible. There are two types of expenses now: revenue expenses and capital expenses. Revenue expenses do not create an assets. These are regular in nature and recurring, usually for short term, for example, payment of salaries, maintenance. Whereas in capital expenses, you purchase a asset. It's an investment. Whereas in revenue expenses, you just maintain that assets. So it's regular and recurring, whereas capital expenses are irregular and non-recurring. These last for long. These are long-term assets. For example, purchase of machinery, purchase of land. Individual expenditure includes the basic cost of living expenses like housing, food, transportation, childcare, healthcare, and other necessities. These expenses differ from person to person based on their style of living. It's basically your income. Expenses that are part of family budget: housing loan, repayment or rent, utility expenses, gas, electricity, phone, water, internet, Wi-Fi, property taxes, school, college fees, health, fuel, entertainment expenses. These are all part of your family budget. This is your individual expenditure, and these are expenses relating to your family budget, that is your expenses. And last concept in this video is savings. Savings refer to an individual's unspent earnings. It is the money set aside for future use and not spent immediately. That is, savings is equal to income minus expenditure. So savings is what you save, deducting your expenditure from your income earned. Thank you.